All right. Well, welcome everybody. Thank you for joining the YCG Annual Client Conference. I can't remember how many years we've done this before, but we appreciate you taking the time this afternoon or this evening, depending on what time zone you're in, to join us for our client webinar here. I'd like to thank and welcome Elliott Savage and Brian Yacktman, portfolio managers and my partners here at YCG. We also have our other team members on the call. I don't think you'll be able to see them, but thank you to the whole YCG team in preparing for this webinar, and just appreciate all of you. And most of all, we appreciate you as clients. It's just a joy to see the list of attendees and to see all of you, your participation and being here this evening. So thank you very, very much. We've got a few slides that we'd like to present. And then we've received a number of questions that we'd like to take the majority of the time to answer this evening. You'll also notice at the bottom that there's a Q&A little icon, and throughout the presentation, if questions come to your mind, please feel free to write those questions, and we'll try to get to all of them and answering your questions. As we begin here, though, I need to read out a disclosure here just from a compliance standpoint, and that reads, please note these discussions may include forward-looking statements which may or may not be accurate in the long term, but reflect our opinions at this point in time. Bear in mind that there are many clients on the call, and we do manage your portfolios to meet your specific requirements. So some positions may not be in all accounts, just to make that clear. Well, let's get started here. Brian and Elliott, thanks again for being here, and we'll roll with the first slide. And Brian, take it away.
Awesome. Well, we won't spend much time here, but just by way of background, for those that aren't clients that are on the call, we were established in 2007, and we're managing approximately $1.5 billion today. A little over 500 million of that's in the mutual fund, and approximately about $1 billion is in separately managed accounts. And the business, as you likely know, is owned by myself, Will, and Elliott, all on this call. And we take great pride in investing alongside our clients. So when the ship sinks, we go with you. And when the rocket takes off, we go with you as well. We experience all the ups and downs together. And it's amazing how studies show the results, the difference when you have a manager who's invested right alongside you versus when people just are throwing darts for you. And a simple, just the type of style of investing we do, we're high quality investors. The main goal we're trying to do is identify businesses that are earning high rates of return on their capital and can do so for a long period of time. And if you continue to do that long enough, then we believe and have seen over time how stock prices tend to follow and track the types of returns that are being produced inside the business itself. And so we really are studying and analyzing the businesses and trying to own a collection of some of the most dominant businesses on the planet that can act as toll takers on the rise in global wealth. And so moving to the investment philosophy, we invest, as I just mentioned, in global champions. We're laser focused on finding businesses that have enduring pricing power. And Elliott will get into more on what we mean by that. But in short, how we identify that. But in short, what we mean by that is that if you were to see an identical company get created that creates the same good or service as the company you own, the question is, as you compete against each other, and if they strive to make things better, faster, cheaper, can you continue to charge a premium price because there's something special about your business that you are able to still grow your volume despite the competition? It's extremely rare to come by, and that's why why we have such a narrow portfolio. Is it's very rare to find enduring pricing power. And we want to have a long runway to be able to have a long runway of volume growth. And ideally with that long runway, also the ability to grow those returns on capital, that whatever your high returns are, not only are they maintained, but hopefully that they can actually grow, that the returns on capital can grow as you continually reinvest. Then we look to protect our shareholder interests, because if you are a minority shareholder of a company, we want to make sure that the management team is doing things that won't destroy our position. And so we love to find family-owned businesses or businesses with owners who are strongly motivated and passionate to what they're doing, as opposed to, say, more of a rent-seeking CEO type that's just in there for a couple of years, and then they just kind of are there for a job, and then they move on to the next CEO position somewhere else. And then we also want to be aware of aggressive capital structures, because there will come bumps in the road. We know they're going to come. They always do. But what we want to be able to do is have a business that will survive and even thrive through those hard times. And then we want to make sure that we're not overpaying for the business, so that we can actually enjoy the returns from the business. And we have found that on average, high quality businesses tend to be priced very attractively, because most investors are seeking to get rich quick. And they know that they're not going to get rich quick by just dabbling. Excuse me, dab is not the word I'm looking for. By owning and hanging out in really high quality businesses. And so they get impatient and they tend to orphan these really high quality businesses. And so it's almost like you get paid a premium to be willing to own boring businesses. And we find that to be our sweet spot. And then once we've found this great collection of businesses that we believe can act as a toll taker on their respective industries and on the rise in global wealth, we just, hopefully, if we've done our job right, we can sit on our hands and just wait. But obviously, occasionally changes come and the market offers opportunities or new information. And so we're always looking to try to upgrade and give to you guys and ourselves the greatest portfolio that we believe will produce the greatest risk-adjusted returns.
Yeah, and so just a little bit about kind of how we look at the stocks. So there's a universe of 58,000 stocks worldwide. As Brian mentioned, we think high quality stocks are kind of like the best house in the stock market, and so we immediately narrow that down to high quality stocks, because we feel like then we're fishing in this good pond that we believe can perform well on the downside, but also participate in global wealth. And then within that category, though, what we're really looking for, even high quality businesses, because of competition and innovation, they tend to have declining returns on capital over time. And so we're really looking for a subset of that high quality pool that can buck that trend, and that can actually raise its prices and and either maintain its returns or even increase its returns on capital over time. And what we found is that businesses that can do that generally have 6 characteristics. And one of the most important ones of that is the business possesses a dominant network effect. And the reason that's important is because number one, so the way network economies work is that as the network grows, the value to users grows exponentially. And so what that means is that a very large network provides way more value to its customers than a small network. And that makes it very hard, once you've got this huge network, to have new competitors come in. And then the second thing that enables is that it enables for, as you add a new user, the value goes up exponentially, because every other user gets some value from that new connection. And so we can then, as the network grows, the business can take some of that additional value in pricing. And so you can grow your pricing over time while still providing really great and growing value to your customers. And that's what causes these pricing increases to be sustainable over the long term. And what's really interesting is that because of that exponential increase, a lot of times what happens is that the value of the network grows a lot faster than the price than the rate at which the companies are raising their prices. And so that leads to this big gap a lot of times between the value that the customer is getting and the price you're charging. And so we've been able to find with some of our companies that this measurable big difference between that value and that price. So like one example that we always use is Moody's, where essentially they save their customers 30 to 50 basis points, yet they only charge 8 basis points. So they could triple their prices tomorrow and still their users would continue to use them. Then we also want to provide, we don't just want that network effect. We also want other checks that make it hard for new companies to come in. And so one example would be like a not in my backyard zoning restriction. The best example of that would be the waste businesses in our portfolio, where no one wants a landfill in their backyard. And so what you've seen over time is that the number of landfills in the US and Canada has actually been declining over time, because it's literally probably impossible to get a new landfill. And so we love that, because even if someone wanted to come in and compete against these businesses, they really can't. And then so on that side, we have sort of the supply. And so we want the supply to be kind of flat. But then we also want demand to continue to increase over time, because if you think about it, if supply is flat and demand keeps growing over time, then that means that pricing will go up over time. And so the other thing that we look for is businesses where the demand is highly likely to grow over time. And to use that waste example, customers can be fickle about the types of products that they like. Sometimes they like this one type of drink, then they move to another type of drink, then they move. But what we feel comfortable in predicting is that waste over time will grow, and we're really looking for categories that will grow as fast as GDP. So we're looking for areas of consumption that are going to be at least as important in the future as they have been in the past. And then the other two that Brian already mentioned is just we want the ownership-minded management teams and the conservative balance sheets. And then so once we find those businesses, then we want to get as long as they meet these, most of these 6 criteria, then we just want as diverse a portfolio as possible of those types of businesses, because the future is completely unpredictable, and so and no business is disruption proof. And so we just want to have the ability to have a diverse portfolio that can be resilient against many different possible futures. And if we've done our job right, as Brian mentioned earlier, what this results in is a global portfolio of dominant toll takers across categories in the economy that are important and becoming more important over time. And later, after we're done with this presentation, if people have questions, we'll go back to this slide. And if people have questions about any of the particular companies or industries, we're happy to discuss. And then if we move to the next one, this again, it's just kind of breaking up the portfolio into different types of these network effects that we talk about, and we're happy to talk about this. If it's of interest to anyone.
So I'd say that the consistency of which we've stuck to this investment framework has been the cause of our outperformance when it comes to the concentrated composite strategy. And obviously, some of your returns may be different to this. This is a composite, an aggregate, and we've actually compiled this composite since the 2008 year. But you can see the returns year to date, 1 year, 3 year, 5 year, 10 year, and since inception returns, and really on all metrics, 1, 3, 5, 10, and since inception, we have exceeded net of fees, by the way, as well. We've exceeded the index of the MSCI World Index, which in our opinion is the index. If you're going to truly be passive and own everything in the world, then the MSCI World Index is the index to compare ourselves to. There is about a 10% more invested in international stocks within the MSCI World Index relative to our international holdings. I will say though, about a year and a half ago, well, actually about a year ago, we actually held more international stocks, but we sold out of our Indian and Chinese businesses, and perhaps we can address that a little later on. But those are our returns that you can see. This is just another way of showing those returns. The annual returns are these. I'm going to go fairly quickly through this though. You can see the annual returns of this same composite strategy going back to the full year of 2009 and then all the way through 2023. Our top 10 portfolio holdings as of March 31st. So Amazon being our largest holding, and Microsoft, Google, MSCI, and then Copart being our top 5. And you can see the others down that list as well. From a country allocation standpoint, again, about 83% of the YCG strategy is in US stocks, with exposure in France, Canada, Ireland, the Netherlands, and the UK. And you can see the difference between our strategy and the MSCI World from a country allocation standpoint. Here it shows the different sector allocations versus the MSCI World Index. And I think this is fairly instructive. You'll notice there's a huge kind of overweight in financials. And I'll make the point where these are not balance sheet financials, right? Where we have a large exposure to the traditional banks. When you look at financials, think of like financial light businesses where there's not a lot of balance sheet risk. When you look at Visa and MasterCard and Aon, Marsh Mac, all of these are being considered as financials, but don't hold the risk of kind of balance sheet financials as we traditionally think of, the banking sector per se. But there's maybe a question that comes from this, and you'll notice that there's no exposure to energy, healthcare, or materials. And really, we'll probably put energy and materials together in the same bucket. But Elliott, could you speak on why there's no exposure to healthcare as it relates to our investing framework?
Yeah, so again, kind of big picture, what we're looking for is we're looking for these dominant networks in industries that can grow at least as fast as GDP over time. And so all three of these areas don't fulfill one of those characteristics. So in the case of healthcare, if you think about how healthcare has grown, Buffett has kind of referred to it as the tapeworm of the U.S. economy. So it has grown a lot faster than GDP over time, but our concern about healthcare is we really like businesses where there's a clear market signal about the value of products. And the problem with healthcare is that a lot of the businesses, it's unclear if the profits that they're making are because of regulatory capture, because they've been able to kind of get around the healthcare rules, or if it's because they're really adding that much value to their customers. And if we can't parse out which part is regulatory versus like how much value they're adding, then if regulations change in the future, we could have many surprises, probably mostly downside surprises in terms of how much these businesses can own or can make. And so therefore, even for like a big network like United Healthcare, we just don't think that the 10, 20, 30-year economics are very predictable because of those regulatory risks. And then in many of the other ones, like sort of, prescription drugs or medical devices, those are more like technological, where you would expect like the technology sector, for the prices to actually be deflating over time as new companies figure out how to do things faster, cheaper, and better. But what you actually see is that because of the sort of healthcare regulatory framework that many of these businesses kind of make, don't have that deflation. But again, if regulations change, then you could see a lot of that deflation. And so we just don't think it's predictable, which pharmaceutical drugs will be, popular in 5, 10, 15 years.
Makes sense. Brian, can you speak on why the no exposure to energy and materials?
Yes, I think just in short that it comes back to no enduring pricing power. So in both of those industries, you're dealing with essentially commodity-like characteristics where nobody really cares whose oil it is that you're buying. They just want oil. And over time, what we've seen is an upward pressure on supply. As a society, we get better at making things better, faster, cheaper. And so there's an increased supply. But then on the demand side, you can see a decrease in demand as we come up with better recipes so that we need less of something, or better alternatives that you don't even need it at all. And so upward pressure on supply, downward pressure on demand, it leads to declining pricing power over time. In fact, in energy industry, I believe the statistic is that over the last 40, 45, 50 years, energy has declined 66% as a percentage of GDP. So meaning that your wallet, you have an additional 2/3, whatever it was going towards, energy in the past, you now have an additional of that percentage. You have an additional 2/3 from that original amount you had slated for that budget. You now have an additional 2/3 that you can spend on other things, other discretionary goods and such. And so you contrast this with other industries like, insurance, where as you become wealthier over time, you now need to insure things. Whereas before you had nothing to insure, now you want to insure things. And so insurance has shown that it's maintained its percentage of GDP over time, almost like a cosine or a sine graph, going up and down, but pretty much straight across. Similar with advertising. Advertising is if your neighbor's advertising a lot, your competing business is advertising a lot, you need to advertise a lot to take mind share. And so as a relative good, advertising's maintained its share of GDP.
Luxury goods.
Luxury goods, prices go up over time, wealth goes up over time. You have to raise your prices in order to continue to signal that your luxury goods are valuable. And as wealth grows up in the world, you're able to spend more towards these luxury goods. And so luxury goods have gone up quite a bit. Now, healthcare does follow that. So that's the difference between healthcare and, say, energy and materials. Healthcare has actually increased as a percentage. But as Elliott pointed out, there's a real concern that it's almost like a cartel that could be busted up that's not true value to the consumer. But like Buffett said, more like a tapeworm to the economy. So if regulations change, you might get in trouble.
Awesome. Well, looking back in the last year, we thought we'd show what the top 5 contributors were to the portfolio return. And as you can see, it was Amazon, Microsoft, Alphabet, which is Google, Copart, and Moody's. And the bottom 5 detractors for the portfolio returns were PepsiCo, Tencent, Alibaba, Nike, and Estee Lauder. And we're going to speak to this. Well, actually, why don't we go into that right now? Let's keep going. I won't get distracted here. Let's finish off with some of the key product features of the strategy. So again, Brian Yacktman and Elliott Savage are the portfolio managers. They've been there since the beginning. We have a very consistent process with our research and our investing framework. We're pretty disciplined in what we invest in. You can see that we're attracted to those high quality businesses and love, short-term mispricing opportunities where those come about. We're obviously actively managed and have a concentrated portfolio anywhere from 20 to 40 stocks, where a majority are in our top 10 holdings. So kind of high conviction strategy when it comes to that. From a position sizing, Brian, you want to speak to that briefly? I mean, 20 to 40 may sound like a lot, but I think maybe for some of our clients, they haven't thought of this in these terms as far as combining themes, so to speak. Do you want to speak on that briefly?
Yeah, sure. So we actually recently had one of our clients just reach out and asked about the concentration,
and maybe it makes sense to actually go back to the toll taker slide while you talk about it.
Sure, good idea.
Yeah, that's a great idea. So as you can see, like these are the way to look at it is that when we take a position, we're thinking of it as a position towards a business line or product or service in an industry. And sometimes a lot of the businesses we own, they tend to become oligopolistic in nature, but there's usually two major winners that maybe one isn't really favored over the other. And so you see that right here, like global payments in the upper left corner, MasterCard and Visa. There's nothing that we could say that we have that's more clairvoyant to say MasterCard will surely outperform or Visa will surely outperform. And so if we don't know which one may outperform, we do find both businesses to be extremely dominant, and we are confident that they'll perform fairly similarly. And so we own both of them so that we don't take on the idiosyncratic risk of just picking one. What if there's some sort of fraudulent thing that happens, or who knows what? But there's no reason to take on additional risk.
One really good example would be just you might get a CEO in there who's super acquisitive and decides to buy some unrelated business just because he or she wants
empire builder.
Yeah.
And so then they acquire like crazy, and then they use up the cash flow that could have been yours to increase value, ends up being wasted and burned on poor acquisitions. But similar, like global insurance activity, we look at Aon and Marsh Mac. Verisk, we actually look a little bit different, but it is in the global insurance activity area. But Aon and Marsh Mac are extremely similar, and actually their stocks almost behave identical and have for 20 years. So no reason, again, to take on risk of just picking one when it looks like they should perform similarly. And so this could be said about a bunch of like when we're building a high luxury, ultra luxury portfolio, well, we said, well, let's assemble Hermes, Ferrari, LVMH. These are the creating our own ultra luxury business line, if you will. And so you can look at these and truly be like, you are an owner of these businesses. And so, I could go on and repeat it over and over, but it's the same concept. Waste management, Republic Services, both. There is actually some reasons, I guess I won't go into too detailed, but there are some reasons that actually look like Republic Services does seem to maybe be a little bit stronger. But waste management, on the other hand, is a lot cheaper. So it's tricky to say, but there's no reason for us to really say we know for sure Republic Services will outperform waste management. So bottom line is your 30-ish holdings, that you have, we view them as it's actually more like you probably have around, 15, 12 to 15 type concentrated positions, I'd say, that are expressed in many more stock holdings. So
awesome. Thank you for that. Let me go back to where we were then. So obviously our objective then is to get the highest risk-adjusted return for you and to outperform the MSCI World Index over 3, 5, 10-year rolling periods, and to have tracking error of anywhere from 5 to 10%, which we're accomplishing right now. There's our bios, the three partners. We really couldn't do it without our great team here at YCG. So shout out to Michael Yacktman, Lily Long, Mike Clausen, and Brenda Lee. And just very grateful for the work that they do here at YCG. All right, well, that's the end of the kind of prepared slides. I'm going to quickly go through our disclosures that we are obligated to share with you, and our GIPS report that shows the concentrated composite strategy and its disclosures. But I really want to get to our questions. So let me go back to this slide where we'll leave it there. And again, thank you for those who submitted questions. We're going to do our best to answer them. And again, I mentioned this in the beginning, but there is a Q&A function or a little button at the bottom of your screen. Click that and feel free to submit your questions if you have any, and we'll do our best in answering those real time. But Elliott, I'll throw the first question to you. And it's really kind of a two-part question. The two main concerns. Yep, go ahead.
Do we want to talk about just the recent portfolio changes?
Oh, that's a good idea. Thank you for that. Yeah, let's do that. Let me go back to this slide right here. Yeah, why don't we cover some of the recent portfolio changes that maybe some clients have seen and had questions about. Why don't you take that? Go ahead.
Sure. Yeah. So basically, and we'll discuss a little bit more of this later on in the call. But one big theme, there's been this big artificial intelligence boom, and people have really been bidding up the companies that people believe to be the winners of this boom. And Amazon, Microsoft, and Alphabet all are part of that. We think they're definitely likely to benefit a lot from AI, but potentially people have gotten ahead of themselves in terms of their excitement about artificial intelligence, and we just want to maintain a diversified, balanced portfolio. And so recently we have reduced, Alphabet and Amazon somewhat, and also another one of our big outperformers, Progressive, and we put them into we added to our Chicago Mercantile Exchange position, which has lagged, but is still a great, dominant, essentially monopoly that is, an exchange where you can exchange various types of interest rate futures and energy futures, et cetera. And then we also put more into MSCI, which is kind of the global, it's in our presentation. It's the benchmark that all asset managers compare themselves to. And it's a company we've owned since 2012, I believe. And it's been one of our best performers. It's an incredible business, but it's been recently weak. And so we thought it was a great time to take more of that up. And then the last thing is we actually added a new position, and it's a business called FICO, which imagine everyone on this call is familiar with the FICO score. And that's also an incredible business. If you go back to the page that shows how our research process, it really checks off all of these boxes. So it's a business with dominant network effects. It's essentially the score used by all the different credit rating agencies. It has one competitor called Vantage Score, but most people haven't heard of it. When all the banks package the debt and sell it off to investors, so like if they're writing mortgages or they're lending, on autos or things like that, then a lot of times what they do is they take all of those loans and then they sell them in the capital markets to investors. And FICO has 98.8% of the market share of those securitizations. And so it's essentially a monopoly, and it's got this, and the network effect is similar to like a Moody's and an S&P Global, where it's a protocol network effect. So network effects, check. And then it's got significantly untapped pricing power. It's one of the businesses that we feel like has more untapped pricing power than almost any in the portfolio. Essentially for 30, how we talked earlier about as businesses grow their networks, the value to consumers goes up exponentially. And then normally businesses will raise their prices to capture some of that value. But FICO, they were founded in 1989, and for 30 years, they did not raise their prices. So it became more and more popular. People were using it all over the place, and they didn't raise prices for 30 years. And then starting in 2018, they started raising prices on their business, but still in mortgages, still FICO scores are on average about 5 cents per score. And so if they just grew that by 1 cent, it wouldn't really change how valuable it is to the lenders, but it would be 20% more revenue to FICO. In mortgages, they charge $10 to, if you were to get a mortgage, you have to get credit reports, and they charge $10 for their score. And the credit rating agencies charge $70 for their credit report. But then the closing costs are $6,000 and the mortgage is $350,000. So they're charging $10, but they're an essential component to getting that $350,000 mortgage. So if they doubled, tripled, quadrupled their prices to $40, it would still be an irrelevant cost to the end mortgage, since it's the most mission critical part of getting that mortgage. And so we just think that's incredibly favorable. And then they're in a business that will grow in an industry that we believe will grow as fast as GDP. It'll grow kind of with housing and consumer credit values, which typically grow along with GDP. And it's run by an ownership-minded management team that they own, 400 million plus of stock themselves. They have a conservative balance sheet. And so we just love everything about the business. Maybe Brian, just also talk about that it has the market timing mispricing that we really like as well.
Yeah, I mean, just one of the things that's interesting here is that in the housing market, if you look at like historically, the average, what's the word I'm looking for? Loan originations, home mortgage loan or mortgage originations were about like 15 million a year back right before the Great Recession in 06, 07, somewhere around there. Then the Great Recession happened and housing, fell off a cliff. But even when it fell off a cliff, it only dropped to like 7 million, I believe. And then for the last 10 years or so, you've been doing around 10 million loan origination, mortgage originations per year. And as of recently, though, in 2023, as interest rates went up, it's like the housing market completely froze up. And when it froze up, I mean, you're now, this last year in 2023, there was only about 4.5 million loan originations. So in other words, it's almost a half of what the bottom was during the Great Recession. That's how much it's frozen. I mean, that's staggering. And it could very well be that if rates just start to come down, regardless if they do or don't, there's a backlog. There's pent up demand for people to switch housing. I mean, that's pretty clear from looking at the data, and that will eventually trickle out. And as that eventually trickles out, then that could lead to a nice boost to earnings on their home mortgage business.
And that's one of our favorite things to do is to buy businesses that check all 6 of these boxes, but that also are experiencing kind of macroeconomic headwinds to their business, because people tend to want to wait for those interest rates to go down to jump back in. And so we find that if we can buy a great business when it's experiencing kind of short-term difficulties, that especially if they're just kind of macroeconomic in nature, that it's just a huge opportunity over time.
Awesome. We had one question, and maybe I'll just address this real quick. It says, how is the portfolio done in recessions or at times where the market has been in distress? Likewise, when the market as a whole has a high valuation, how has that affected the portfolio? So this slide shows you kind of how we've done. So 2011 was the year of the European debt crisis, if you recall. And so the MSCI World Index was down 5.5%, where we were up 7.8%. So strong performance during that year. And then again in 2015, market was slightly down to flat. We were up 3.7%.
I think that was Brexit year, right?
Yep. And then, and frankly, if you look at all these years, we're beating, for the most part, the MSCI World Index. 2012 was a bit of a struggle year. If I recall, I'm trying to remember, was that when we were invested in for-profit education? I can't remember if that was the year.
Yeah.
So that's our one underperforming year. But 2018, again, we were down, but definitely less than the market of the MSCI World Index. And then in 2022, we were down more than that. And the only sector that was really positive, if you recall, in 2022, were the oil stocks, energy. And we've already explained the rationale as to why we don't own energy. We believe it's in a secular decline, doesn't have pricing power, enduring pricing power. And for all of those reasons, we're still not going to own and have exposure to energy, and we're fine with that. Plus, it was,
Will,
yeah, go
I
ahead.
was just saying, you might say, well, why not just have oil for diversification's sake, so that when 2022 comes along, you can do
Sure.
better. But the reality is you'll be really glad you didn't own oil all those other years.
Good point. I would also say it was kind of a global portfolio. It was a rough year for a global portfolio. So a lot of the technology stocks, a lot of the global stocks that had these global network effects really got hit hard. But they rebounded very, very quickly after that as well. And you have to remember that for the most part, you're invested in equities. And, you take Warren Buffett, for example, and over the lifetime of his investing career, he's had 3 or 4 times where he had over 50% drawdowns, where his portfolio was down by that much. And even more so if it was, if you look at the periods when he was down 30% or 20%, even more times than that. And so the key is owning great businesses that have these strong balance sheets that kind of determine their own destinies and actually grow stronger in those weaker and difficult periods, because they're able to actually gobble up competition and actually strengthen their moats coming out of those weaker economic cycles. So we feel the strategy has done well during kind of weaker recession moments. And then as far as high valuations are concerned, you can't just look at PE ratios and say, oh, that stock's expensive. Because if you look at a business like an Intuit, like an Hermes, I think the market discounts and doesn't appreciate that untapped pricing power component to the business. And all of a sudden, if you have a business that can double, triple their pricing and still maintain their growth, all of a sudden that business looks, very cheap. And people, look over that. And I think that's something that really resonates with us. And we've seen it time and time and time again. And so I think, our portfolio does very well on the surface when it looks like things are pretty expensive. That untapped pricing power really comes to fruition when you're looking at things. So good question. Thank you for that.
And it helps add to predictability, that when you do go through the tough times, it adds to the predictability of the earnings stream, because they have more control over the destiny of their earnings stream.
Great point. All right.
And I would just make one more point that, what you're gonna experience volatility in the equity market, and a lot of the kind of yearly returns are noise, frankly. So kind of in our view, the way to look at equities is over, a 10-year period. But then also, there are times when there is a big signal, like in a Great Depression. And what you'll find if you look back at like the Great Depression, where many businesses were going bankrupt, the AT&Ts of the world, the big networks that were like dominant and necessary, they actually became like a higher percentage of the market than at any time, before or, after. And that's because they had those incredible economics that enable, or like a Coca-Cola, you know, they had those incredible economics that enabled them to survive and even thrive through those periods. And so our view would be that it's hard to tell year to year, you know, how things will look just because of the natural noise of the market. But we believe that, you know, given how strong and necessary our businesses are, that like in a truly scary depression environment, that these businesses would do much better than the market.
And Will, one more quick point.
Yeah.
Because you brought up 2022. You know, I just want to point out that normally we would actually believe that our portfolio will, in most environments, hold up better during those bumps in the road. But in that specific case, it being a very high inflationary year, that's probably the one thing where we're probably the most vulnerable in the short run. But as can be seen, when you add the 2 years together, 2022 and 2023, we still came out ahead in the end. But during that first moment when you have a big inflationary bump, because a lot of the businesses we own, the value of the businesses is the cash stream that is far into the future. And as opposed to, say, a business that people know is not doing very well or it's struggling and it trades extremely cheap, those businesses are less affected by this. But when people know that they want to own this business because it's long, the value is long into the future and it's enduring, it makes it so that it's more like a long-term coupon bond that's more vulnerable to interest rates. And so the point I'm making is when rates go up, the valuation multiple will shrink drastically at the outset. It's not that anything happened to the businesses themselves. The businesses were fine. It's just the valuation shrinks quicker because it's more levered to interest rate movement in the short run. And then as the business continues to plow forward, it just pushes forward, and then you see the long-term result. So,
and I would just say that the high quality, if you look at the whole set of high quality equities, not just the ones we had, that whole set underperformed the market by kind of a similar amount in that year, because of the dynamic that Brian's talking about.
I think you bring up a good point. You know, you watch a CNBC or something like that, and it's so short-term oriented these days. And we don't think in terms of 5-10 years, a full market cycle. And I think, you know, with this strategy, you need to be patient to see the fruits and the disciplined approach kind of really helping you increase your returns over the long term. So I think long term.
But the good news is it helps us sleep well. It helps us sleep well at night when those bumps come, because we feel confident that what we own is enduring and will win out in the end.
Yeah. There was a follow-up question about FICO, and I think it's a good one. It says FICO was around 750 at the end of October 2023. Any reason why it was not picked up then?
Do you want to take that, Elliot?
No, go for it.
Well, I would say what you really should be asking is, we saw FICO when it was under $200 a share in March of 2020. And it was attractive to us then. The reason it wasn't picked up in March of 2020 at $170, $80, $90 a share was twofold. One was we didn't fully understand just how wide the untapped pricing power was. And secondarily, there was a lot of, it was extremely levered. It was not conservatively capitalized at all. But now that we understand, if I could go back in time and understand the pricing power, just like we said, sometimes stocks appear more expensive than they really are. This was a case where FICO was far more conservatively capitalized than it appeared, because they could easily just pull down the lever. If things went more awry during COVID, they could have just said, okay, well, we're going to raise prices by X amount, and they'll easily have enough cash to cover their debt. And so it would have been fine. But we didn't have those insights yet. And then by the time we did have the insights, it was, you know, frankly, it was just a mistake that we didn't get it soon enough. the mistake was, gosh, this thing just took off like a rocket. Surely we're going to get maybe just a little bit of a better opportunity. And we felt like we already own all these other great businesses. There wasn't anything that we were scared of trying to like absolutely eliminate. And so as we were waiting for better opportunity to come, it just kept getting more expensive. But then the additional insight that really said, look, we really should still just own a piece of this is, number one, it's one of the strongest businesses out there that checks all the boxes. And number two, the insight of the mortgage loan originations, and that being a fairly decent chunk of the business, we recognize that this could actually. So what I would explain is, it's not appropriate to compare today's FICO stock price to the past stock price, because they did pull on the lever to raise prices. I mean, they literally like raised prices 3.5 times. And just
7
like
times. Yeah.
Okay,
Yeah,
from the beginning.
since 2018, it's been the 700% price increase to get to the $10.50, which is still a tiny amount compared to the $350,000 mortgage. So, yeah.
So it's 700%. And if you have a business where you can keep raising prices, even just whatever inflation is, just do inflation +1. Even just do inflation, and you're better off than almost any business out there. And so the point is that it's not actually fair. It's almost like the stock chart took a new reset. And when the pop happened, it was like, hey, they just pulled on the lever. And then, wow, did earnings just drop to the bottom, and earnings just exploded. Now, they're not going to keep doing that forever and ever. But the point is that now that they just did it, this is a new regime, if you will, a new profitability that's here. And on top of that, now that we know what that new profitability is, with the loan originations being in such a cyclical down period, it could actually end, being that it's much cheaper than it appears, and it could be a really great period to be buying it. So.
Yeah, and I mean, I would also just say, the best time to correct a mistake was yesterday. The second best time to correct a mistake is today, right? So we shouldn't let our past actions prevent us from doing something that today, with new information and new understanding, is a good thing to do. But both in selling stocks or buying stocks, it's just with the information and understanding that we have today, what is the best portfolio that we can set up?
And I throw out one more thing, which is, we would love for FICO to drop back to $700 a share. So you guys can pray for that for us, and we would love to take advantage and really increase the position size. And we're just always at any moment just saying, okay, based on the current price, where do we want the portfolio to be structured today? Though we may have tax restrictions that reduce that create friction, that make that more difficult. But yeah, we would actually welcome that. Even though we just bought FICO at this price, we would welcome, like, please drop 50%, because we're that confident in the future that then we could really scoop up shares and take a more meaningful position.
All right, let's move on to our next question then. What about the two main concerns we see in financial markets? One being China and the other inflation. What are your thoughts on these 2 points?
Yeah, so I'll take China, and then maybe Brian can do inflation. Essentially, clearly there's a rising tension between the U.S. and China. We're seeing both sides engage in trade wars, and we're seeing rising nationalism. And what that's doing is it's leading to a bit of a more deglobalized world. So you're seeing lots of companies trying to, we were in kind of a period where it was sort of make the supply chain of the world as efficient as possible. And what that meant was each country specializes in, a couple of specific things. And then it's sort of like just in time inventory, everything was just in time. But now with these rising tensions, what you're seeing is that we're shifting to a world of resilience. And so that means that everyone is saying, okay, since I don't know what the future is going to hold, I want to have more of my manufacturing done close to me with some of my the people I trust. And so you're seeing a big trend of the US moving manufacturing to closer to home, to places like Mexico and just also in the US. Now what the various scenarios that could occur, it could just be that we're in sort of a simmering Cold War for a long time, and then things kind of calm back down. It could be that things calm back down sooner than anyone expects, or it could be that this sort of Cold War translates into a hot war, and we really just don't know what, no one knows what the future holds. And so our view is, number one, own businesses that have the strength and dominance and importance to society, that they have many degrees of freedom to adapt to whatever the future throws at us. And then secondly, I would say this is another reason why we want to find as diverse a collection of businesses as possible, because we have some businesses that would really benefit from a reduction in tensions in China, such as the luxury goods companies or Apple. And then we have some businesses that would really benefit from a continued escalation of tensions. So that would be the railroads, waste management, where that nearshoring trend, if that just picked up pace, that would mean more manufacturing happens in the US, meaning more goods need to be transported by the rails, and more waste is going to be created that the waste collectors then pick up. So those would just be a couple thoughts about China.
Oh, yeah, and then I'm supposed to speak on inflation, was the question?
Yep.
Just so yeah, I mean, with inflation, I guess my number one thing here is to say that before I say anything on inflation, the really great news is that when you have a strategy like this, we don't have to actually know what will happen to inflation. You prepare a portfolio that, if it's chock full of these global champions that have enduring pricing power, should inflation come up, the good news is that businesses with pricing power can raise their prices to maintain their margins. If they're needing to refinance debt at higher rates and it squeezes margins that way, again, you can just raise prices. And so I think the key is actually, rather than trying to predict inflation, what you really should try to predict is what businesses have pricing power. That really is the key. And I would say, because trying to focus on what will happen with inflation, I mean, if there's anything that has shown us, just look at these last few years and how much you see headlines saying rates are going to be down forever, and no, rates are going to go up forever, and then it was back to no, rates are going to go down and stay down forever. And we've gone back and forth like crazy over the last 10 years or so of the belief of what will happen with interest rates. And what's clear is that we're usually wrong. I mean, in some cases, it's literally been within only a year or two later, it's the exact opposite of what every pundit was saying was going to happen. And so there's too many variables to try to predict, because inflation is trying to predict the supply and demand, and it's not just the supply, it's more supply and demand in one category. So you're looking at the supply of money relative to the demand of money, and you're also looking for the supply of goods and services relative to the demand for those goods and services. And all of those come into play of creating inflation. And it's just, there's too many variables, too difficult to predict. So we just don't waste our time trying to do so. But we do, again, look for pricing power, and then try to also build a portfolio that's fairly robust, that has some businesses that may excel more in an inflationary environment, and then some businesses that may struggle, or I should say succeed more in a deflationary environment. And that helps also provide some ballast to the portfolio.
Awesome. Another client asked, what Warren Buffett recently said that he feels comfortable selling Apple and building cash in this market environment. What are your thoughts about allocating some percentage to cash?
Yeah, so I would say I feel like there are kind of two components of this. Number one is selling Apple, and then number two is raising cash. And so number one on the Apple, I would say he said it will it's an even better business than Coca-Cola, and he's going to continue to hold it as the largest position in his portfolio, indefinitely until, his successor, Greg, maybe decides differently. So, and we we totally agree that Apple is an incredibly dominant business with really high returns on invested capital that appear to be, getting higher over time. The key statistic on Apple is that I feel like there are two key statistics. Number one, it's like a 98% renewal rate. So like if you have an iPhone, you're like 98% likely to get an iPhone for your next phone. And then the second statistic is that 90% of young people either have an iPhone or want an iPhone. And so it's going to continue. It's likely going to continue to gain share in the U.S. and the Western world for many years. And then on the cash component, Brian, why don't you take that? And I just had a couple thoughts to add to that as well.
You're saying about just like, would it make sense to build the cash?
Right.
Yeah. So, I mean, again, we just think that these things, the market is just too complex. It's more like a biological system than it is just here is the physics law, and you can accurately predict. They've shown so many studies of that when you try to time the market, you end up worse off than had you just invested. And that's because on average,
I would highlight what I just looked at the numbers on this, and so the kind of gold standard is the Dalbar study. And they said that over the last 2 years, equity investors had lagged the market by 8% cumulatively, so 4% per year. And if you think about that, the market over time.
You said over the last 2 years?
Yep. Yeah,
okay.
8% cumulatively.
Right.
So 4% per year. And if you think about that, the return of the market over the last 125 years in the US, which has been exceptional, is 9.5%. And globally, it's 8%. And outside of the US, it's 7.5%. So you're talking, close to 50%. And for the world, over about actually exactly 50% of your returns you'd be giving away by trying to chase either what's worked or by trying to raise cash over time. So we just think it's doesn't make sense.
There was I remember a study done by another company, and they showed like over a 20 or 30-year period. This is back, I think, like through the 80s, 90s, and then into the 2000s. But they did this period, and they showed it was with mutual funds and people trying to time the mutual funds and get in and out versus the mutual fund itself. And similar data, but I think in that one it was even worse. I think they showed like 80 to 90% off. Like they call it the investor behavior
penalty.
Yeah. And that behavior penalty was, I think it was like, the study's been done so many different ways and different times, but it's usually somewhere between 50 to 90% penalty. So if you get a 10% return in the market, you end up with 1 to 5 by trying to time it. And then you hear the anecdotal stories of the people who they get out in March of 2009. They can't believe it. They throw in the towel. I'm done. They won't get back in until they get a really big correction again. And then this is a true story. And then they finally got in right before COVID when the market's up like, 3-4 times from where it was at the bottom. And then they capitulate right at the bottom again. And so you can have these really extreme scenarios too, where it's just absolutely awful. So I think the key here is trying to time it is really a loser's game. We believe you're much better off owning these great businesses that you can feel confident and comfortable to know that they'll work out over the long run as a collection. And then during the hard times, you might use that as an opportunity when the market says, hey, I'm willing to sell this thing to you at a real massive discount. And you're like, wow, I can't believe you're so depressed. You're willing to give me that for that price. And I can't believe that this other business that I still love held up so well. It's not down nearly as much. It might be down, but it's not down nearly as much. You can sell this guy that's held up so well and really take advantage and scoop up shares of something at a great discount. So we look forward to market dislocations because oftentimes you make your money during a bear market. You just don't know it at the time. You're not feeling it at the time, but it'll pay dividends in the long run.
And I would also just add though that there's no kind of one size fits all for like how a portfolio should be structured. So from our perspective, it really is it comes down to kind of like the individual situation and personal preference in terms of I do think it makes sense if you want cash available for your near term liabilities, over the next few years. I think that's you're paying insurance for that. So, you shouldn't expect that that's going to do as well as if you had it in the market on average, but you're paying insurance in case there's a Great Depression or something like that, by having that emergency cash there. And so I would think of it as cash as sort of an insurance policy against one of those really bad depression-like scenarios, and how much insurance people want to buy is a personal preference kind of thing.
And I like the way you put that, because insurance costs money. And if you go into cash over long periods of time, it's going to act as a cash drag. It will detract from the portfolio returns over the long run if you assume that the market will have a positive expected return. That's the percentage by which you're paying for, whatever your expected long-term return is, multiplied by the amount you have in cash. That's the drag. That's the cost you're paying per year for that. But to your point, what you don't want is someone who says, well, I don't have any cash, and when the market collapses and they say, let me out now. And had they had the cash, it would have given them more stability and temperance to be able to, with that calmness and cool, cool assurance, to say, okay, it's going to work out. And then
to just stick with it. Yeah.
To stick with it. So in those cases, it does make sense to build the cash that would bring some comfort to the client.
I think that's probably why Buffett too has, a certain percentage in cash, because such a big part of their business is in the insurance business, and they need to insure themselves against catastrophic losses. So there's that component to that as well. Well, good. That was a great answer. We have another question. Your stocks are mostly US based. Why are you using a world index? Is basically the question. So the world index, the MSCI World Index, remember, has 70% allocation to the US and 30% international. Our portfolio right now is 80% US and 20% international. We'd actually expect, and we would like to own more international businesses. Frankly, we've scoured the world for kind of rails and waste collection businesses, but a lot of times you'll find that these are owned by local governments and aren't investable. But I would think that over time, our international allocation probably increases over time. And like I said, we actually did own more international with our Indian and Chinese stocks. And so that's an appropriate index for our strategy, just given we can invest in businesses all across the globe. We might be a little bit light on the US allocation side, but the MSCI World Index is pretty close to how we're geographically invested. And don't forget too that because of these are global businesses, most of the revenues from these global businesses are coming from outside of the United States. So if you were to look at a map of where these revenues are coming from, it is a very global portfolio from that perspective. And probably more important to look at that characteristic as opposed to where the business's headquarters are domiciled. So that's probably.
And Will, and I think probably the biggest thing that I would want to make sure is pointed out is that the MSCI World Index is truly the only passive decision that's out there. If you wanted to say, I don't know where to invest, what do I do? You buy everything in the whole wide world. And so what we're competing against is, can we beat everything that's out there that's available?
Yeah. Okay. Another client question about a holding. Estee Lauder has not performed well over the last 3 years. Why do we still own it?
Well, I want to first thank whoever's asked this question. Thank you so much for pointing that out for us. Yeah, it's so I'm going to feel a little bit like I'm going to talk out of both sides of my mouth here, but I think it's important that you see both sides. So I want to point out that first of all, Estee Lauder does still dominate with, the number 1 or number 2 spot in prestige beauty in 40 countries. So more on the luxury side of things in the skincare, makeup, cosmetics. They are, they still have a very strong brand portfolio. A lot of many of their brands are, if not number 1 or 2, they're at least in the top 10 of these global premium brands. So you may not be aware of a bunch of them, but brands like, so obviously Estee Lauder, but Clinique, MAC, Aveda, Bobbi Brown, La Mer, Too Faced, Tom Ford Beauty. So a lot of these brands that good chances are that if your wife or daughter is using makeup, it's owned by Estee Lauder or L'Oreal. And historically, Estee Lauder actually has proven to be super savvy in their marketing and R&D. They tout that their ability to use all this, they use all sorts of data to try to create and understand what does the consumer really want. They talk about having over 200,000 daily data points that get plugged in to figure out what the consumer wants and how to have the product arrive in the right place at the right time. And I'll get to this in a second, that wasn't totally proven true because there were definitely some mishaps there. But they do have advantages on sheer size that gives them cost advantages with procurement of materials, manufacturing those materials, and then the logistics and supply chain to get it throughout the world. As a background in the industry, it's super awesome. I mean, there's a huge long runway for growth opportunities. We're in a selfie generation, as we call it, where people are taking photos and posting things all the time, and they want to look great. And it could be argued that even during bad times, people would rather eat ramen noodles, or they would rather trade down on their costs so that they can just eat ramen noodles than to show up in public without wearing any makeup. And so in some ways, makeup can actually be, interestingly, somewhat of a recession-resistant type good, very mission critical to people. And when I say like a long runway for growth, there's billions of people that are being added to the middle class. I mean, they estimate over 100 million people are added every year. Over 100 million people added to the middle class every year. So that's easily over 1 billion in the next decade, and some people even estimate 2 billion. And when you look at per capita spending, in the US, people spend, it's like over $100 per person on makeup per year. But in places like China, it's only in the 20s. And then in India, it's like $1 to $2 a person. So there's still a long runway for more of these products to be sold and for the pricing of these products to increase over time. And I also want to point out that private label penetration is pretty low in beauty categories. It's only like 2 to 4% private label versus a lot of other like consumer packaged good categories. It'll be low double digits. And what that shows is consumers are less price sensitive to cosmetics and skincare, makeup, and they're more loyal to their beauty brands. So it's very clear that brands do play an important role in this category. Now, I've explained a bunch of positives about this, but what happened? Why did the stock do so poorly? Well, they bet really big on China right when a recession hit China. And so it caused all sorts of operational issues and inventory management issues. And in some regards, it's actually pretty similar to what's going on with Nike, where Nike misread the tea leaves during COVID and they mismanaged the supply chain. And so they had a big backlog of inventory trying to work it through. Very similar thing happening here. In fact, they had beauty sales rose for the first time after 7 contracting quarters. They finally rose 8%. And so it does seem that travel retail is improving. And so we think that these are probably operational issues that were more just short-term oriented. Management themselves seem to be taking the right steps. They're well positioned in Asia. They have highly regarded brands there, with La Mer and Estee Lauder. But having said that, they only have half of Estee Lauder's 20 plus brands are currently available in China, India, Brazil. And so there's still a lot of opportunity to grow and increase their presence. They have a new factory in Japan. They opened a new innovation center in China. And so they're really looking to extend their brand reach and increase their volume of product. So I think it's sort of like, I think of it almost like tarnished silver. If you pick up a piece of tarnished silver, someone might look at that and be like, oh my gosh, this looks disgusting, and just, want to throw it away. But it probably is just that it needs a little bit of polishing, and with a little bit of water, vinegar, baking soda, and this thing is looking bright and beautiful again. And so I think that there's been more temporary travel retail issues, because the new mall has essentially it's gone from more of a mall-based distribution to more of like airports throughout the world. And so I think these travel retail issues, they probably haven't derailed Estee Lauder's long-term prospects. But having said all of this, at the end of the day, it's pricing power that matters most. And really the question is, even if these temporary issues are solved, is there any long-term structural problem at hand? And there's no question in our mind that the pricing power of Estee Lauder is not nearly as strong as, say, like Ferrari or an Hermes Birkin bag, though granted, very few things are. And so the main issue is that Estee Lauder, there's really no checks on supply, so it doesn't check the box. While there is a great industry of growth, and we believe that they will pump a lot more product through this industry growth over time, there's no guarantee as to what their returns, those margins will be, because there's no checks on supply. You can have a celebrity person that just says, I created my new product line, and then they push it through social media, it goes viral. And now Estee Lauder or L'Oreal is like, hey, we need to buy this. And they have to overpay for this to buy it out, and then they pump it through their distribution. And they do get a lot of growth, and they've historically done this extremely well over and over. But it seems like the pace and speed at which the supply is increasing from competing demand from social media celebrities, for example, is getting higher, which would suggest that it's almost acting like CapEx in disguise that's growing more and more. Or in other words, the percent of cash that the business generates is likely becoming less. And so to what degree that's happening is unclear. So there's all these positives still there, but there's potential less returns than there have been historically is the question. So like just to give you an idea, it was only 2 years ago their gross margins were 76%, and today they're at 70%. And their net margins have gone from 10 to 4%. Again, part of that was operational. But if you can imagine, if their net margins go from 4 back to 10, or let's just say they go from 4 to 8, all of a sudden, even though the stock just rebounded significantly, and it does look fairly, it looks pretty well, fairly valued, it may actually be far cheaper than it appears if all of a sudden this flushes through the system and their earning power just doubles. So it's hard to say exactly. But overall, I guess what I would say is we're keeping an eye on it. And given the current price and given the positive, bright future that the cosmetic industry has and their position in it, we're not like, it's not like this is a stock where we're not sleeping well at night. We believe it'll still do well. The question is that capital better suited elsewhere, or do we want to keep it here because we believe that these operational things will come kind of flush and we'll clean off the tarnished silver, and it's going to be burning bright in the short run.
Awesome. I think we'll try to be done in the next 10 minutes. We've got a couple more questions. Elliott, what are YCG's thoughts on AI and the semiconductor space?
Yeah, so I would say that we definitely feel like AI is a huge likely to be a big source of growth and innovation and change and positive change. Um, and uh, but we would say that it's very similar to the internet in that you had in 2000, everyone felt like the internet was going to be this huge thing, and so everyone put all of this capital into building out the internet. And so you had like Cisco systems, they had routers, and then you had people building all this fiber, connecting all the homes so that you could have broadband internet. And what's tough about these sorts of things is that it's there's a lot of promise, but in terms of actual productive uses, it's very hard to know how much demand, how much, how quickly those productive uses will come to be. In the internet's case, what you had is you had less demand in the near term than people thought. And then you also had many efficiency improvements. So like those fiber pipes, people thought you could put, X amount of data go through it, but it turned out that as they were building them, they figured out all these innovations that meant that there could be 10 times as much data put into it. And so it caused pricing to collapse for these big fiber pipes. And so we think something similar might happen with AI, where you have all these semiconductors being bought by all of these companies. But the question is, will there be a bunch of efficiency improvements, and will demand really meet the expectations? And so we feel like the best place to have our capital invested relative to AI is in these big, essentially like the big railroads of the AI age. So that would be like the Microsofts and the Alphabets, and also the Amazons, where they're basically connecting all these different businesses and giving all these businesses access to AI services. We do not, whereas the semiconductors are a little bit more like the railroad ties. So once the railroad is built, the railroad tie demand can sometimes fall off dramatically because people are like, it's built, so we don't need any more railroad ties. And so we just think that those businesses are a little bit riskier than owning the railroads. And then I don't know if you have any additional thoughts, Brian.
I guess I just come back to a comment we've made in prior webinars before, is that oftentimes when there's technological innovations, it's the users of those innovations that really benefit more so than the investors themselves, particularly if there's not pricing power for it. Now, in the semiconductor industry, there's a lot of businesses that actually appear to have wonderful pricing power. We've looked at a company called ASML in the Netherlands, and they do this photolithography type method of selling these machines that help produce the semiconductors themselves. And they have incredibly, fat margins, high returns on capital, 90% market share. But the thing is that if there was some leapfrog event that said, oh, we found this better way, and the stock cratered, I mean, we have no idea to really know, is it now problematic forever, or is this business going to be okay? We wouldn't really know. So it's kind of too technological for us to really take comfort on the semiconductor side, at least at this point. And then, I'm going to bring up one other point that I thought of was, as you were speaking, I started to just kind of reflect on AI and thought, AI is interesting because it's producing a society of people who are being acted upon more than choosing to act, and they're being influenced more. I guess what I'm saying is, think of our own habits. If you get on your phone and you just start scrolling mindlessly, and you don't really go to your phone for a reason, you just feel this urge like, oh, I just need the dopamine hit, and you just go and you open up your phone and you just start doing things. You're more being acted upon by this device, and I think what that lends itself to is more manipulation over time, to allow the strongest to get stronger. and for there to be more of like, it's already become more of a winner take all economy just through network effects. And I think that AI itself could be something that helps strengthen that position, that the global champions are in a place that makes it even more of a winner take all economy, or winner take, most at least. So would add that. And then there was just one other minor thought that I had.
I would just say that we're very cognizant of it. And we know that in these sorts of transitions, in the internet, the newspaper business was an incredible business for many decades and then was just destroyed by the internet. And so we're really, thinking through all of our businesses and how they could potentially be disrupted by AI. And for most of them, we feel like it's probably going to be more of a benefit in terms of cost savings and things like that. But there are a couple that, probably like the ones that I would point out would be like Adobe and to some degree Google, or Alphabet, where we're just kind of thinking through the kind of positives and negatives for AI on those businesses.
And to that point, I mean, Adobe had great, they actually increased. At first, it got a hit because people were like, oh my gosh, AI is going to destroy Adobe because now you can just create content you can just say, I would like you to create this and have this and do that and whatever. But then the stock completely rebounded to the other direction where it's like, wait, Adobe's actually going to be a huge AI winner because they're going to roll all this AI technology into their stuff, and it's going to make it even more impenetrable where people are going to share their files and network through these files and create things through using AI through Adobe. And now it's kind of, it's yo-yoing. And the similar with Google, the question is, will they become a winner of this AI battle? Or, they've had such a stronghold on that precious real estate of the search box. And now you've got AI bots that can actually, they can easily do things for you where you can just say, hey, Siri, this, and that, and they can bypass going to the Google search. That's the idea, is that over time you may end up completely just not even going to Google. But then, who's going to have the best technology to go from AI bots to then AI agents? Well, first of all, who's going to have the best AI bot technology? And then who's going to have the best AI agent, where the agent actually acts like your personal executive assistant, doing everything for you, where you say, I'd like to book a flight from here to here on this date. I'd like it to be somewhere in this window of time. I want to be in an aisle, and that already knows your credit card information and your frequent flyer information and just logs in and it buys the ticket for you. And just handles the whole thing just when you barely quickly say something through your telephone to it. So there's definitely changes coming, and coming back. The main point is what Elliott just said. We're just constantly looking at the portfolio and saying, will things be strengthened by AI or disrupted? And if it's going to be disrupted, we watch it really carefully to see, will they be one of the disrupting winners in their own industry? Or, at the end of the day, we just want to get a great collection of these dominant businesses so that we know that when the bumps come, we can sleep well, knowing that in the long run, we have a strong belief it's going to work out.
Well, these have been great questions. Thank you, clients, and those of you on the call today. We've enjoyed reviewing those, answering those questions. Hopefully this time has been helpful to you in understanding better how we think, how we invest. We'll finish up with the last question here. It says, how much alpha do you get as to when you buy your positions? In other words, how much, if any, of your return is based on the timing of your purchases or sales versus the underlying holding? I mean, I'll respond to that quickly, and then Elliott and Brian, feel free to add to it. But I think the answer is with regards to our turnover ratio, and our turnover ratio is pretty low. It's anywhere from 10 to 15%, which means that we're holding our positions in excess of 5 years. Many of our positions, we've held them for over 10 years. And so overwhelmingly, the alpha comes from the underlying holding, the underlying business. And as far as the timing of when you purchased, in the short run, that matters a lot. But in the long run, the underlying business and how strong that business is, and does it have untapped pricing power? Does it have this long runway for growth? is really what matters. So I guess that would be the short answer for that. But Brian, Elliott, anything else to add?
I would just say that that there's a catchy phrase that people say about the market. It's not timing the market, it's time in the market. And I would just say it's the same with these businesses. It's not really timing entering and exiting the businesses. It's just time in these great businesses that's the real driver of returns.
Yep. And I was going to say, imagine if 10, let's go even further. Let's say 25 years from now, and we brought up buying FICO. If you bought some FICO today at 1,300, let's say that the stock is at, it's at 13,000, 25 years from now. There's no question that if FICO goes from 1,300 to 750, again, we would love to hoover up the shares, and it would end up being a greater return from 750 than 1,300. But over that this comes back to your point. Well, I'm just trying to illustrate it by example. If the stock declines a big amount, it's not, or sorry, said another way, we just paid a premium for it relative to where it was not too long ago. If you amortize that over a 25-year period, it's only going to take a little bit off of your total return. At the end of the day, it comes back to how much cash was generated by the business over that time frame. So,
yep, absolutely. Well, thank you both. Thank you everyone for joining. We just love having you as clients and appreciate you taking the time out this evening or this afternoon to join us. And we love answering your questions. So if you have any follow-up questions, you know how to reach us, and we'd love to talk one-on-one. But otherwise, have a great evening, and we'll talk to you soon. Take care, everybody.
All the stocks we've mentioned should not be considered a recommendation to buy or sell the stock. Consult your financial advisor for your specific situation. You can also request from YCG a list of all the securities that we've recommended over the last 12 months. Thanks for watching. Check out our other videos, and we'll see you next time.